Wealth Nation, today we want to help you find money that's hidden in plain sight. And we are going to do so by having a guest speaker come on who is very near and dear to our hearts. But first, my name is Carmen.
And I'm Darius.
And we are thrilled to introduce you to an amazing mentor of ours. He has helped thousands of individuals across the United States with business planning. So let's talk about exit planning, succession planning, and overall key person planning, and just really finding opportunities for businesses to cash flow more efficiently. So I want to introduce you to none other than the Tim Yurek. Thank you, Tim, for joining us today.
Well, Carmen and Darius, thank you so much. And it is certainly my pleasure to be here.
Awesome. Now, the elephant in the room for most business owners is going to be how to best leverage their cash flow. And I know, on YouTube and on Google, when we research, there's a ton of different strategies out there for people to use when it comes to how to use their cash flow. With the 35 years plus of experience that you have, what are some of the things that clients come to you with, issues they come to you with that you help them with as it relates to their cash flow?
Well, that's a great question. So here's the thing. We've done a lot of research, and our research has found that there was a study done by Intuit that found that 61% of small business owners around the world struggle with chronic or cyclical cash flow issues. And 69% of those small business owners either lose sleep or sleep less due to cash flow concerns. Now, we can go down the rabbit hole of, sleep deprivation causes stress, and stress increases our incidence of cancer by 200% and heart disease, by 40%. And for small business owners, the life expectancy of a small business owner is a full 5 years less than the average American. And think about what effect the cash flow issues are causing or leading to that stress, right? So that was something that was very eye-opening to me. But the fact of the matter is, in all my years of working with small business owners, here's what I found. All of these cash flow issues categorically are self-inflicted. And the reason it's self-inflicted is because we have literally been trained to use our money by the financial institutions we're dealing with, by the government, by the large corporations, our vendors that we're dealing with. We have been trained to use our money in a way that is beneficial to them and to our detriment.
Mm-hmm. It reminds me of the fox protecting the hen house. And just in this situation, we're listening to the fox for financial advice.
Yeah, referencing the Becoming Your Own Banker book by R. Nelson Nash. Yeah, absolutely.
Exactly. So, and I'm glad you brought that up, because ultimately becoming your own banker or infinite banking concept is the way to leverage that cash or that cash flow, right? So let's take a look at sort of what got me to this point.
Okay.
When I first started in financial services way back in 1985, you guys probably weren't even born in 85.
I was born in 85.
Darius was. I came a year later.
Well, what does that make you feel? But the issue is that our industry teaches us, because I wanted to work with small business owners. I've always had an entrepreneurial spirit. As a kid, I used to cut grass, rake leaves, do all sorts of odd jobs, anything I can do to make money on the side. And so I sort of have this special place in my heart for entrepreneurs and business owners. So when I got into the financial services industry, I said, hey, I want to specialize in working with small business owners. And that was great. And our industry really teaches us on how to communicate to a small business owner's a small business, our industry teaches us how to communicate to a small business owner a problem that they either weren't thinking about or didn't realize they had. So think about it. I walk into a small business owner, he or she is, worried about day-to-day cash flow, employees, accounting, sales, production, all these different issues. And all of a sudden, I walk in their office and I talk to them about exit planning and succession planning and key person retention planning. And they're like, oh, geez, yeah, that makes sense. So again, our industry is really good at helping us to communicate a problem. We're really good at teaching us how to put a price tag on the solution to that problem. But where our industry falls very short is on showing the business owner how to pay for that problem.
Mm-hmm.
And, going back to when I first started, it was really difficult because I'd call on a small business owner. I'd explain to them a problem that, again, they may not have been even thinking about or realized that they had. And then when I walked out, they're like, yeah, I need to take care of that problem.
Mm-hmm.
And then I come back the next week with a solution and they're like, let's say, it's a $500,000 problem with a $4,000 price tag to solve the problem. And the business owner would look at me and say, hey, Tim, if I had $4,000 of extra cash flow, you better believe I would want to solve this problem. I'm having a hard time making payroll. How in the world do you expect me to come up with $4,000 or $5,000 or $8,000 or whatever it is? So I would walk out, I'd walk in there thinking that I have a potential prospect or client and that I'm doing good work and solving a huge problem for this person. And then I walk out and I'm like, this guy's more frustrated today than he was when I first met him, because now he knows in the back of his mind he's got a problem, but he can't afford to pay for it.
Mm-hmm.
So that's when I sort of struggled to figure out a way to help business owners come up with the cash flow. And one of the things, it was crazy how it sort of dawned on me that the cash flow problem was self-inflicted. So I'm going to take you back to 1993. I'm at my parents' house. It's Christmas time. I had moved out, had a place of my own, come back. Me, my brother, my sister were visiting with my parents, and we're talking about the good old days. And of course, the good old days weren't as good as you would like to think. I didn't realize it at the time, but we were definitely lower middle class. I would say we were poor, but we didn't know it. We didn't realize it.
Mm-hmm.
So at the end of we're talking about the good old days after dinner one Christmas day, and in 1993, and sure enough, it comes to the time where we went to get my dad's pay. So my dad would get paid on Thursdays, and most Thursdays he would come home with his pay, give it to my mom, and then she would take it, cash the check, and do whatever she had to do with it. And one Thursday he came home, and it would happen maybe 2 or 3 times a year where he didn't have his pay. And so we ended up driving to the guy who owned the plant where my dad worked. We sat out in front of his house until he got home, and my mom would get my dad's pay when the gentleman came home. And the one time we were talking about the time where the car wouldn't start. So after my mom got my dad's pay, our car wouldn't start. So my brother, knocks on the door. We had to call my uncle. My uncle came, and we thought, it was just a dead battery, but of course it wasn't. So then we had to get a ride home from my uncle, and it was, sort of like a pretty embarrassing thing. And I was probably like 8 or 9 years old at the time.
Mm-hmm.
So we were talking about this, and I remember saying to my mom, the Christmas of 1993, I said, Mom, what were we doing there? And she said, well, I was getting Daddy's pay. And she said, and I said, well, why didn't you just wait till the next day to get it? And she looked at me, and I'll never forget the look she gave me. She said, honey, we lived pay to pay. If I didn't get his pay that night, they were going to turn off the gas or the electricity or something. And she said, that was just the way we live. And Carmen and Darius, it was sort of like a lightning bolt hit me, because I'm sitting there as she's saying this. I'm thinking, oh my gosh, I'm living pay to pay. Now at this stage of my life, I'm 31 years old. I'm making 6 to 7 times more than my father ever made in his best year. I have no children. I'm not married, and I'm living pay to pay. And it dawned on me at that exact moment, I'm living pay to pay by choice, because there's something I'm doing wrong that's making me broke periodically. And I couldn't figure it out, because here's the irony. I was in financial services. I was recommending to people to do exactly what I was doing. And if I was inflicting this punishment or this pain on myself, what bothered me was, what am I doing to my clients? Because we were following conventional financial wisdom. Now think about this. At that stage, I had a 15-year mortgage. I bought a house 2 years prior, and I had a 30-year mortgage, but I refinanced to a 15 and increased my monthly payment by like $180. I was maxing out my 401k. I had probably $150,000 in a 401k. That may not sound like a lot of money. It was a lot for a 30-year-old. And I was doing other things, all the other things that we're trained to do. And I realized, like, it's not the amount of money that I was making that was holding me back. It was something else. It was literally how I was using my money. And that's when I sort of started seeking out better ways to use my money. And some of the things I figured out myself. And then there were certain financial planning programs that literally teach us how to use our money in a more advantageous way so that we're in control of our money. And once I started doing that, first of all, it freed up a lot of money for me. I mean, it literally changed the course of my life like that. And I started bringing those concepts to my clients, incredibly well received, and more importantly, getting significant results for them. And that's when I knew I was onto something.
Thank you, Tim, for sharing that. It's so important for people not only to hear your story, but it's important for people to remember, like you said, some of the things that we're doing is conscious or subconscious, right? And so today we just hope to really expose our unconscious or conscious spending, because it's about, like you said, it's about death by a thousand cuts. And how do we start having a more proactive approach towards our spending? How do we bring more awareness in what it is that we're doing? And especially, like you said, as business owners, sometimes we tend to take our personal finance practices and bring them over to the business, and that can wreck the system. And so we've learned so much from you just in the conversations that we've had, and we're thrilled to be able to share your framework that we'll go through in just a moment. I know you wanted to say something, Darius.
Well, I was just in your story understanding the parallels in our personal spending and our business spending if we don't have good financial habits. The conversations that we should be having, be it personal or business, should all be one and the same. We should be thinking about cash flow instead of nest egg when we think about like our personal expenses and how we spend money. And if we can start having more conversations like the one you had with yourself in your 30s of, okay, if my income is 6x what my parents was or how I grew up, how's my expenses also 6x that? So by understanding that and putting it back into our pipe and smoking it, we start to see, to your point, that makes sense, where everybody's issues come from their own self-inflicted things that we've decided to do to ourselves. So with this understanding now, what are some of the strategies that we can start with on boosting our income so that we can have that cash flow, and so that we can get to a point where we're able to leverage that understanding and cash flow to legacy?
That's a great question. And I think it all starts, Nelson Nash shared with us, right? It all starts with the way you think. And
mindset.
Right? Isn't that it's so, it's so foundational. But think of it this way. When the way you think is to look at things through the lens of being in control of your money, all of your decisions from that point forward are made with tremendous clarity. Because if you're presented with two options as to how to use your money, and I'll use one example. Let's say you make $50,000 per year, and you're faced with the option of putting 10% of your pay into a 401k. That's $5,000. Now, once you put that $5,000 in the 401k, you no longer control it. You say, okay, what if I don't put that $5,000, that 10%, in the 401k? If I put it over here instead, into an account in which I have complete liquidity, use, and control. So all we're doing is we're saving the same 10%. It's the same $5,000, but it's different if and when we need to access it.
Yep. I wonder what product you're talking about, Tim. Life insurance. But anyways, go ahead.
Well, so this is where it comes into play with a business owner. So think of it this way. You're a business owner. You want to save money for retirement, or you're saving money for retirement. But because you're saving money for retirement, you don't have access to that money. Cash flow is always an issue for business owners. And now you're taking some of that cash flow, some of that money that you've, worked really hard to generate profits, and you're taking it and you're putting it off the grid. And now when you run into a cash flow problem in the future, or worse yet, you have a business opportunity in which you want to take advantage and you don't have access to that money, that's very frustrating.
Yes.
So now, if you put the money in a place where you do have access, you can take care of an emergency, a cash flow issue, or more importantly, you can take advantage of an opportunity. And again, it all starts with the way you think.
Mm-hmm.
So one of the strategies is just to not to lose control of your money.
Exactly.
Keep your money in an environment where you always maintain control of it, so that you can access it to use it in the event you do need it, because we need it as business owners, because our income goes up and it goes down and it fluctuates depending on what's going on in the world, and we have that experience. But number one strategy, or one of the strategies you're saying, is just to not lose control of your money.
Absolutely. And again, that starts with the way you think, right? So if you're thinking or viewing things through the lens of being in control, that's 90% of the issue right there.
Got it.
That solves all of your problems.
Got it.
What else did Nelson teach us? He taught us that this is not complicated. It's incredibly simple. But we make it complicated. We as individuals complicate it. But so understand, what I do with business owners today now is we talk about those business planning issues. exit, succession, key person retention. And then we present the solution, but then we show them that, hey, you also have the cash flow to support this. You're just using it incorrectly. And if we show you a more efficient and effective way to use your cash flow, now you could not only solve the original problem you were trying to solve with your cash flow, but now you can solve the succession plan or exit strategy or whatever business strategy that we talked about or you want to solve. So that's $1 doing 2 jobs. And oh, by the way, when we start building up cash in this plan, then we're going to teach you how to leverage or access this money so that you can continue to run and grow your business. $1, 3 different jobs. Now you're just killing inflation.
Mm-hmm.
So that brings the question, like once we start to solve our cash flow problems, we want to make sure that we protect it. So talk to me a little bit about key person insurance when we're thinking about making sure that we maintain the expertise within our business in the event that somebody retires or has some type of health issue where they're no longer able to work there. How does key person insurance come into play with making sure that our business continues to cash flow in the event we lose somebody?
Yeah, so that's a great question, Darius, because there's 2 issues there. There's the loss of revenue to the business by through the loss of that key person. And then there's the loss to that person's family of that individual's income. So how can we sort of package this to solve both problems? Well, there's a lot of interesting things that can be done. But first and foremost, we look at insuring the business, the individual, so that the business owns the policy, so that the business could benefit if that key person doesn't show up for work, because they died the night before. But the other issue is you can also sort of stack this in a way or arrange it in a way where the individual's family will also benefit. Maybe through a salary continuation plan where the business owner says to their key employee, hey, you just continue to do what you've been doing. And if one of 2 things are going to happen. You're either going to make it to retirement or you'll die before. If you die before, we guarantee that we'll provide 5 years of your income to your family should you not make it to retirement time. Well,
Amazing.
Well, think about this. What type of goodwill do you think that would bring from that employee to his employer?
It definitely helps with retention, especially for small businesses.
Mm-hmm. Yeah, and especially with these days, it appears in the marketplace that it is difficult to maintain retention because everyone's just going to the highest bidder. So now it becomes a conversation of what can I do as a business owner to maintain my employees and what perks and things can I continue to offer them. So it's a win-win for everyone. It's a win for the business because they don't experience a loss, right? Because when you have a key employee who is managing your day-to-day business, and if something were to happen to them, you do have a source of income that comes in so that you can rehire, you can retrain, and then also their family of the person who lost it is covered. So it's an amazing opportunity for sure.
Yeah. So let me explain some. Again, we've done a lot of research for small businesses, and what we found is 48% of your employees, that's almost 1 out of every 2, is either looking for a better opportunity or open to the conversation. That's troubling. If you're a small business owner, your key people are more important to you than it is to a large business, because in a lot of cases, that key person is probably the only person that has that skill set in your entire geographic area. Let me share a story with you. I have a client. he just retired about, it was back in March of this year. And prior to his retirement, his employer literally begged him. They came to him and said, Joe, how about if you work 4 days a week? He's like, listen, my wife and I are healthy. We just retired, we're going to reach 65. That was always our goal. We saved enough money. I don't want to work anymore. Couple weeks later, the business owner comes back and says, Joe, how about if we let you work Tuesday, Wednesday, Thursday? You'll have a long weekend every weekend for as long as you want to stay with us. But we would love for you to stay with us for 2 or 3 years. He's like, I don't want to stay. It's not, I'm out,
guys. I'm out.
Yeah, I'm out. My wife and I are healthy. We want to travel. We want to do the things we want to do. And I don't want the stress of having to work anymore. So long story short, he ends up retiring. About 2 months after he retired, he and I were meeting and we're talking. And he said, do you know that they had to hire 3 people to do what I did? I mean, that's amazing. And that is so typical of what goes on in a small business. It generally costs over 200% to replace a key person. So whatever that individual was earning, it's going to cost twice his or her salary in order to replace that person's, especially the longer they've been with the company, the worse it's going to be.
Yeah, that's ridiculous.
So point number 2 is keep the people that you got, because it's more expensive to hire somebody else.
Cheaper to keep her?
It's cheaper to keep her.
that explanation goes well there.
Keep the people you have, so you don't have to replace them and spend more money.
So we talked about key person, and I'm glad we're having this conversation, because as business owners, it wasn't until we had the conversation with you where we recognized, like, oh man, we probably should have like contingency plans. So it really dawned on us that the gap that we need to fill as far as understanding succession planning, because I know for Darius and I, we've just been comfortable in the sense of like, we're always going to be around. Right. And now we have a daughter, and we haven't really even put pen to paper as far as thinking, what are we going to do for succession planning? What does it look like? How does this thing pass? So you have really exposed the opportunity that we have to really have a succession plan in place. So talk to us a little bit about what that looks like.
So it's a propane company. There's 2 partners, and what they do is they sell propane heat to residents or businesses, and they fill up these tanks periodically. They come in with their big propane trucks and they fill the tanks. Well, anyway, it's a very successful business, but they're 2 unrelated partners. And they realized that when they first started the business, it was really like sort of just for a job to make money and support their families. But then the business got very successful after 8 or 10 years. And they realized that, hey, wait, not only do we have our incomes that we derive from this business, but we also are building a heck of an asset. And when we did a business valuation for them, and the valuation came back that the business was worth $2.4 million. And they were like, no way. Well, it was, but when you look at the cash flows. So now if one of them dies, on top of their income, they also have this asset that they own 50% of that's worth $1.2 million. So they had, they really realized that they needed to set up a succession plan. What happens if partner A dies? Partner B didn't want to be in business with partner A's wife or widow and her next husband's accountant, right? And that's literally what's going to happen. So they said, how do we set this up? Well, real simple. We figured out what the valuation was. Again, 2.4 million. We insured both of them for 1.2. And partner A owned a policy on partner B. Partner B owned a policy on partner A. So if A dies, B gets 1.2 million, and then they had an agreement, it's called a buy-sell agreement, that said when one of these individuals die, the surviving partner has to buy the value of their business, and they'll use the insurance proceeds to fund it. So now the spouse will end up not with the shares of the business, but with cash equal to the shares of the business. And then partner B, if A dies, will end up owning 100% of the business at 2.4 million. So
amazing. Amazing little hacks, right? We're just
Right.
playing Tetris. That's all we're doing with just these financial products, is just figuring out what is the goal, how do we get the pieces to match so that we win every level,
Yeah.
right? It doesn't have to be complicated.
Yeah. So
Go ahead.
Could I add to that? So
Please.
we set this up. Oh, it must be about 6-7 years ago. And at the time, and remember where interest rates were back in like 2018 and such, right?
Oh man.
So they would buy their tanker trucks. They would buy the truck, and it would normally cost about $375,000 at the time. And they were, again, interest rates were very low, so they were borrowing on their business credit line to buy a truck, and they would generally pay the truck off within 12 to 18 months. So at the time we set up these policies, I said to the partners, I said, hey, one of the neat things about this plan is you can borrow against the cash value and, pay interest back to yourself. And I remember the one guy, he said, well, what's the interest rate? And at the time, the interest rate was 4.5%. And he goes, oh, we would never do that. So wait, fast forward to August of 2023, which was a little over a year ago.
Yeah.
So I get a call from this individual, and he said, hey, Tim, do you remember when we set up those plans and you said we could borrow? I said, yeah. He said, what's the interest rate on one of those loans? And now interest rates had gone up. It was at the time 5.5%. So I said, yeah, it's 5.5%. He goes, I want one of those loans. So I remembered our conversation, and I said, well, what changed? He goes, well, we just bought a truck in July, and I wasn't even thinking. I got my regular credit line draw. We paid cash. We took the draw, paid for the truck, and I just got my interest statement for the credit line. He goes, do you know those SOBs want 9.5% to pay for this credit line loan? I said, wow. I said, so you want a loan because on the policy because the rate's lower? He said, yeah. I said, well, that's all well and good. Normally we would help you get the loan, but I want you to realize how easy this is. So I'm going to give you the information. You're going to call, and when the money hits your account, I want you to call me. So about 3 or 4 days later, I get a phone call from him, and he said, hey, Tim, I just want you to know the money hit my account. I said, oh, that's great. How much? And at the time now, a couple years later, those trucks were now $425,000. And I said, oh, that's great. He goes, yeah, but I didn't believe you that it was that easy. And he said, I said it was going to be that easy. He goes, yeah, but I didn't think it would be that easy. And he said, well, here's the deal. He's used to having to apply and get permission to get money. He's not used to giving an order to get money. And that's not a small distinction. But think of it this way. Business owners go into business to control their own destiny, to be in control of their future, and everything's all well and good until they have to go and borrow money. And then they realize when they borrow money for their business, the bank comes in and they slip a paper in front of you and says, okay, here, Mr. Business Owner, sign here for the business. And oh, by the way, here's another form. And the business owner says, what's this form? And they say, well, that's a personal guarantee. And it's at that point that if you're a business owner, you realize you're not in control.
You're not in control.
Yep. That's such a great story. You're right, because we've had that personal story ourselves, and it is that reminder of like, wait a second, what was our intention? What is our intention, and how do we continue to align ourselves with products and services that allow us to fulfill that intention? Right. So you're absolutely right about that.
And it's that way of thinking or that mindset that we have to maintain going into the business, having a business hat, and as we're going through it, because as income changes, what happens is our mind starts to change, and we start to overcomplicate some of the most simple things. So just because there's more zeros after a number doesn't mean it has to be more complicated. Yeah. So we just have to remember our roots and the reason why we decided to do certain things, and the steps that happen after another really doesn't change regardless of how many zeros you have after your number.
Absolutely.
Yeah. Darius, that is such a great point. And that has to be a key takeaway here, because the bigger numbers don't make it more complicated. It just makes it that much more important to be in control.
Mm-hmm. Right.
Yeah. And going back to your money being hidden in plain sight, how are you spending your money? Is it conscious? Is it subconscious spending? What are you doing to control the bleeding, so to speak? And then not only in addition to everything that we talked about, but now we're talking about how do we create retention in our business by maybe having some sort of key person retention system, thinking about succession planning. Like you thought everything out so methodically, where you literally said that the person A didn't want to then have to split the company with the wife's, the widow's accountant, or that whole thing, and those are the realities that we run into, but we just don't think about it. And so what about like exit strategies? So what are some other opportunities to maybe brainstorm as exit strategies come up?
Yeah, so again, a great lead in and a great question. But before I get there, I'll use that same business, and we'll talk about exit. But before I get there, remember I said they normally paid their trucks off in 12 to 18 months?
Yeah.
So when we were looking for funding their succession plan, the solution was going to cost $5,000 per month. And they were like, well, we don't have $5,000 per month. I said, well, you do. It's in your cash flow. Let me show you. And the way I set it up was, I said, would it be detrimental to you if you paid off a truck in 3 years rather than a year and a half? And he said, well, probably not, but we're going to get socked by paying a lot of interest. Now, remember this. Interest rates were 2.75% at the time. So if they were buying a truck for $375,000, let's call it $400,000. The interest for 18 months at 2.75% on the extra $200,000 was like $5,000, $6,000. So I said, well, Chris, if if that's the case, you're only going to be paying, I think it was $6,250. And I said, is that $6,250 over 2 years? Is that going to be worth, roughly putting away, having the ability to put away over that same 2-year period, $120,000? He goes, oh yeah, that's a no-brainer. But again, what did I say up front? It all starts with the way you think. And if you can just deprogram some of these bad habits, all of a sudden the cash is there. Now let's talk about, these guys are right now in their late 50s, early 60s. And they're thinking about retiring because they're knocking on the door for sure. And now they've got these insurance policies with significant amounts of cash built up, and that's going to fund their exit strategy. So, think of it. If one of them dies before they retire, they got the succession. But if they're both alive and one of them wants to walk away, they have these policies with an incredible amount of cash that's going to be a significant down payment on when they exit the business. So we really got $1 that was previously used to pay off the debt on a truck. It's still paying off the debt. It created the succession plan. It created the exit plan. And they have access to that money and they're using it to buy trucks, all with the same dollar. Again, I look at this and say, show me where this is a bad deal for the business owner.
It's very, I'm trying to find the right word. It's just eye-opening. If you're not used to being creative with money, going back to like the Tetris analogy, and you're just used to getting money, paying bills, getting money, paying bills, getting money, paying bills, it's hard to even elevate your thinking, or you can allow it to be hard if you make it hard to elevate your thinking to really figure out what are some better solutions for you, because it's not always just so linear. Like it can get exciting to think about the things that you can do in your favor, like you said, as opposed to deprogramming and not only thinking about how does my income pay everyone else's, right? Or the people who are looking for your money. How can I really take ownership of my income and make it do what I need it to do for myself?
Yeah, it makes me think of the fact that we look at math and finances the same.
Ooh, that's a good one.
Whereas traditional education says that 1 + 1 = 2. Mm-hmm. And what you're saying for us to change the way we think and look at $1 plus $1 may equal 4, or in your case 4, because of the things you were able to do with that $1 multiple times. You were able to pay for the trucks. You were able to pay for the succession plan. You were able to pay for the exit strategy, and they can even use some of this in retirement. Once they leave and want to take the withdrawals from it for things they can do in their own personal lives after the fact, after they've lived their business lives. So it's really understanding the way we think, going back to when we started this, how we think affects everything. Our habits affect how we look at our cash flow. The opportunities that we can find within our cash flow is dictated upon the way we think.
Yeah. So Darius, absolutely. It is the way you think. And keep this in mind. Every splash has a ripple effect. In other words, if you're using your money in one way, that creates an issue, a ripple effect on the rest of your cash flow, or lack thereof. So just keep that in mind.
Love it.
Tim, we need to talk offline. After this, we might be like, hey, hold on, Tim, what was that one thing again? I need to take a look at these numbers. All right, let's talk about exit planning. I'm really thoroughly intrigued by this. Again, things that Darius and I don't think about because we just think that we're going to sit in Wealth Nation for the rest of our lives and we're going to be happy 90-year-olds still preaching the good word on YouTube, you know?
Yeah. What's the one thing that you find that people that are getting to the point there where they're looking to exit their business, what's something that people that are starting their business 7 years into it don't think about that we should be thinking about when we think about exit planning?
Well, that again is a great question. And I'll say this. My clients over the years who have started businesses with the thought of exiting, they've been preparing from day one for their ultimate exit. And as business owners, we're either going to think of this. You're either going to walk out of the business, you're going to go out boots up, right? You're going to die while you own the business, or you're going to get disabled. Every one of those three contingencies requires money. And if you're not planning from day one for one of those three eventualities, you're really planning to fail. And so I'll share with you a client of mine who had been with me for 36 years. And they started very, very humbly, started putting away $200 per month. And as time went by and their business became more and more successful, they kept adding to that. So much so that when they retired, well, when they sold their business, they were able to wait for the exact best opportunity. Ooh. And ultimately what happened was they had enough money set aside that their financial future was not fully predicated on them having to sell their business. And because of that, they were able to ward off lowball offers for their business. And then they finally got an offer that was literally 50% more than the previous best offer. So they took advantage of it. They literally retired about 3 years before they had planned on retiring. And everything worked out. And the reason it worked out is because they had been preparing from day one. You don't have to solve it all today, but you really need to start moving towards that, eventual exit. Again, you're going to retire from the business, you're going to die in the business, or you're going to get disabled. And all three of those contingencies require money or cash. And if you're not planning for one of those or all three of those events, you're planning to fail.
Got it.
I had to write that down because this is things that we need to think about, because not only the other thing that really hit me, Tim, as you were saying this, is not only is this like from a business standpoint, I was also thinking personally, right? These three scenarios are going to be the same thing that happened to us day in and day out with our families. Right. And are we protected? We continue to have this conversation of, 50% of Americans, as we know, don't have life insurance. And the other 50 that do have life insurance, 40% of them are underinsured. So then the conversation is just like, what are we doing, families? Why aren't we protecting our income from a personal standpoint? And then business owners, why aren't we planning better for exit? Because exit is going to be inevitable. It's just going to be dependent on how the universe chooses for you to exit, right?
Whether or not you want to walk out, get carried out, or limp out.
For real. Yeah.
So
straight up.
So if as we're thinking about this, we started from I guess just talking about cash flow to the succession and exit plans. At what point is it good for a business owner, to reach out to you?
Anywhere along I'll just say this, the sooner the better, but here's the thing, because we're really good at finding that money that's hidden in plain sight, we have never met a business owner that we could not help find a significant amount of cash. I think the least we've ever found was $2,500 per month. And again, we're looking at things through the lens of you being in control. So when you're in control, you're going to make different decisions because we've been, again, trained to use our money so that we're not in control of that cash flow or of the money, of our money, our cash. So now when we change the way you think and you're thinking through or looking at things through the lens of being in control, it might change some of the strategies that you're currently doing. And that would ultimately free up some cash to solve these problems. So
Got it.
Again, when you're able to find money that you didn't think you had, use it to solve a problem that you want to get solved, and then we show you how to leverage that cash to run and grow your business. That's hitting all the right bases, so to speak.
Phenomenal.
Love it.
Thank you, Tim. So Wealth Nation, here's the opportunity, right? You have the opportunity to meet with the man himself, Tim, if you choose to, and we will provide his information below so that you can link up. Because the thing that we recognize is we all have our strengths, and Tim has very much been a mentor for us in us better understanding our business and how it should operate. So if you are curious, if you are thinking about what do I do, if some of these topics resonated with you, then absolutely click on the link below so we can get you all connected. Because again, it's just all about all of us coming together and serving our families and serving our business owners the best way we know how.
And serving our community.
Yeah. So that you can leverage your cash flow to benefit you and benefit everyone that you can touch so that we can just make the world a better place, right? So Wealth Nation, with all of that, thank you so much for your attention. Thank you for investing in yourself. This has been an amazing conversation of over 50 minutes. So you have completely invested in yourself. And with that, Wealth Nation, I want you to remember to own your own lifestyle.
Or someone else will.